Deutsche Bank's new CEO, Gildas Surry, has announced the company will take a step back from Wall Street as it looks to focus more on consumer banking in Southern Europe and the domestic market. This as the German lender reported first quarter net revenue down 5% to 6.98 billion euros, falling short of analyst expectations. Joining me now to talk about earnings season for the European banks is Gildas Surry, partner at Axiom Alternative Investments. Gildas, thanks so much for coming in. So if we could start with Deutsche Bank, obviously it's announced that it's shifting away from Wall Street to focus more on the domestic market and other markets in Europe. What do you make of that change? Do you think that's the right move for the bank?
I think it's the right move, and it's a move that has been long overdue. Previous management wasn't able, in effect, to actually execute this strategy. And we believe that with the new managers, Gildas Surry, but also James von Moltke, that the company is in a position to execute along those lines. And they've come up with some strategic announcements that are coming earlier than expected, because Gildas Surry has been confirmed in the job about 2 weeks ago, and those are welcome by investors.
But we keep seeing this phenomenon over earnings season where banks come out with good results, positive developments, yet the bank's shares sell off as a response. Why do you think the shares are down today?
Potentially, investors are concerned with a dilutive capital raise or rights issue that would potentially be announced as well by the new management alongside these new strategic objectives. But definitely at this price, given the discount, you're getting the investment bank for free. And now the management is hands-on, tackling inefficiencies throughout the investment bank, and they want to refocus the bank on Germany and international markets, but also they want to keep a balance between growth, focus and costs.
Let's switch to UBS for a second, because in January we heard that it was going to merge its international and US wealth management divisions. There was a lot of optimism and excitement about this merger. But do you think now investors might be questioning the utility, given the disappointment in that division? It really fell short of expectations.
Well, if you look through the details, they did get some increase in net new money. So I think it's pretty more of the same, and investors are not necessarily disappointed, but they were probably expecting some potential share buybacks in addition to what has already been announced, the 2 billion Swisses that should be carried out later on this year.
And if you look at UBS compared to its rival Credit Suisse, two Swiss banks there, very different results. There was strength in the wealth management for Credit Suisse, disappointment in the investment bank, and vice versa for UBS. Why do you think the results were so different?
There's a lot of traction at Credit Suisse. They are in their third year of restructuring, and basically they are catching up the lag with UBS, and they've done very well by being more defensive on equity derivatives, but still capturing some very nice gains. And they've done very well as well in FIC. Remember, they've got a very strong franchise in structured products. And also on wealth management, they've done well in terms of revenue growth. If you look at their JV between wealth management and global markets, that has seen a revenue growth of 11% year over year.
But if we look at Credit Suisse earlier in the year, we saw that the guidance was lowered a bit. Do you think it's also the fact that it's come to beat lowered expectations here?
Potentially. I think investors need to be convinced, especially following some remarks by the CEO at an industry conference in February, where I guided that the quarter was very mixed, and they came up quite strongly.
Okay, so if we could just switch focus to Santander for a second, and one key part of the earnings that I was looking at was the UK, where earnings really disappointed. It pointed to regulation costs, competition concerns there. Do you think that that could mean that Santander might, to an extent, move away from the UK and focus more on its domestic market, and indeed EM and LATAM, where it's been performing very strongly?
Exactly. Santander is very much of a hybrid between emerging markets and developed markets. about 51% of revenues come from developed markets. So you're looking at a franchise which is definitely tilted towards emerging markets, and in particular LATAM. The strongest country is actually Brazil. And Santander UK is about 10% of their revenues. And so it's a fairly diversified balance sheet which is geared on emerging market growth, but also to their benefit in Spain and also arguably in Poland. There is some growth coming from the Eurozone, as mentioned by the bank lending survey that was released on Monday. There is a very strong dynamic on growth as well. Lending volumes communicated by Santander on Tuesday were up. Deposit volumes were also up. So it's very much of a growth story.
Also on Santander, it's got this EPS target of double-digit growth by the end of 2018. Do you think that's achievable?
Yes, potentially. They try to distribute also probably half of their revenues, or half of their profitability via dividends. And this is something that they're going to do via cash only by 2019, and they've moved away from a scrip dividend to a cash-only dividend, which is positive for shareholders. But also the remaining portion will be split between RWA growth and also financing investment into the platform.
What do you make of the M&A landscape for European banks at the moment? Because we saw Santander carry out a merger with another Spanish bank last year, but it's ruled out any further deals of that kind. I know that in Europe they're quite keen to try and consolidate the banking sector. Do you see any potential tie-ups? I know when we spoke last time we were talking about BNP and Commerzbank, for example.
Typically, looking at Spain, one of the consolidators, you can argue, is Sabadell with TSB. Recently, TSB has some issues in moving to the new IT platform, and also from a growth strategy, Sabadell is not looking at other acquisitions either. So M&A in banking is a hot topic, but it will remain a hot topic, especially for regulators. Daniel Nui at the ECB is willing to see some consolidation, but unfortunately that's something that we are seeing more in the insurance sector. So Standard Life and Aberdeen selling their insurance to Phoenix, or AXA bidding for XL. In the banking sector, this is a trend that still remain to materialize.
I also wanted to ask you about digitalization, because that seems to be the real key to future growth for these banks as the investment banking portion really shrinks. I mean, you mentioned to me earlier that UBS spends 10% of its budget on digitalization. Santander is another big one. Lloyds has got this 3-year, £3 billion plan. Is that really the key?
Definitely, it's the key. It's the crux of any strategy. I listened to the Deutsche Bank investor call this morning, and for them also it's key to invest in digital, in tech, in order to provide to their customers the sort of online solutions that they are willing, that they are expecting to find from their bank. And
just finally, what's your top picks in the sector? I mean, judging by what you've been saying, Deutsche Bank looks like really good value where it is if this strategy plan does pan out. What do you think? Deutsche Bank, there is still some potential dilution on shares, so we are constructive on the name, but rather through debt or hybrids. We like BNP as a defensive play, very strong and diversified balance sheet. And we also follow closely Barclays and Credit Suisse, given the fruits that are being delivered by the current management, or to be delivered by the new management at Deutsche Bank. Okay, Gildas, thank you so much. That was Gildas Surry, partner at Axiom Alternative Investments. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.